Welcome again, and today we are going into the next lesson in our week 4, and it's been a ride. I don't want you to be in a hurry or when am I going to start? All of those things. And this lesson is going to be important to you, and every other lesson that we've had is also of importance to you. So I need you to relax, calm down, and assimilate all that we have been going through. And for your questions, you can always send them to me so that I can answer them, which is the benefit of having me as your personal mentor instead of just watching a YouTube video. So welcome again. Today's topic is common beginner mistakes to avoid. So practically, you might also be feeling the same emotion right now on some of the things we are going to be explaining, some of which I went through personally, some of which I have been able to um, overcome and still growing in the process as well. So let's get down to what we have in the note. Every trader starts as a beginner, and making mistake is part of the learning process. However, some mistakes can be avoided if you recognize them early. So today we will cover the most common beginner mistakes in Forex trading and how to prevent them. Avoiding this pitfall will save you money, time, and frustration. I'm excited about this one because if I had this when I was starting out, there was some mistake as a beginner that I made that I didn't have to make. But this is good for you. So let's go to number 1, trading without a plan or just winging it, right? So many traders jump into the Forex market without a well-defined strategy. This is like driving without a map. You likely get lost. And when we talk about this strategy, the word strategy in itself looks bogus, like, ooh, I have this strategy that does this, that does that. But that's not everything. It doesn't have to be that, it's a no-brainer when it comes to strategy. The strategy is just a plan you put in place on what to do, how to do it, and when to do it, basically, right? So the solution to trading without a plan is to create a trading plan that includes your entry and exit, right? Your entry and exit rules, your risk management, emphasis on risk management, and then trading goals. Uh, the lessons that we've had from the beginning of our mentorship program, we had spoken about entry and exit rules. I've always told you, go back to, I think, with 2 of our lessons, you find that risk management, which we recently completed, is very important, as well as trading goals. When all of these things are in place, even though you are yet to be perfect, you are yet to be the best of traders, what these things will do for you is to keep your mental health in check while you are practicing to become a better trader. If you don't put this in place, you are going to suffer, and you might even quit trading entirely and become an anti-trade person in the society, basically. And the second thing here is stick to your plan. Don't trade based on emotion. So when we talk about this, not trading based on emotion, it's not an easy thing. It's not, emotions are not something you just turn on and off. But when you have a trading plan in place, you become like a robot. You become, oh, when I see this, I do this, right? If I don't see this, I'm not doing this. So the emotions of, oh, this looks nice without basis is going to be reduced and silenced out as you continue in your trading journey. Now, mind you, this is not something you achieve in a week or in 2 weeks or in 3 weeks. This is something you do as you practice and practice. It's like football. You are learning how to play football. You know how to play football, but you still have to go to training, play with other guys. You have a match coming, you still practice and train over and over and over and over. That is just what this is. Let's move on to number 2 of what we have here. Over leveraging. Remember when we took the lesson leverage? I mentioned that each brokerage account with your broker might be set at a leverage, right? You might want to go over that all over again. But what we mean by over leveraging is that doing too much, basically doing too much on an account. Because leverage allows you to trade larger amount, but too much leverage can wipe out your account quickly. So what this means is, let's say you have a $50 account. If you use a 1 to 10 lot size, you might not even be able to place a trade. I remember having to trade on Forex.com. It's a very big broker, regulated broker, and the leverage on the account was 1 to 50. When I place a trade on that account, I cannot place more than 0.01 on that account because the leverage on the account is 1 to 50. So I couldn't, on Euro USD, for example, I couldn't place more than 0.01. If I try to open two positions, it will not allow me open. Why? Because they are helping me. That leverage ratio is helping me to keep some things in place that will not blow out my account. But when let's say that account now has 1 to 500 ratio, on that $100, I could open multiple positions, which is not healthy for my account. Because remember when we spoke about positioning, we said only risk 1 to 2% of the account per trade. Now, the guy that is using 1 to 2% on his account is not stupid. He understands why he has to do that because he's not here to buy Lambo tomorrow. He's not here to just get into a position with his $100 and make 1,000 and say they are flipping account. No, he understands that it things that you water grow. So doing it gradually, you have $1,000 account, which I advise that the list of your account should be $1,000. You are not going to be trading it like you have the whole 1,000 to throw away, right? You are risking just 1 to 2%. What's 1% of 1,000? It's $10. It looks small, but calm down, right? $10 in 10 wins is $100. You have successfully done 10% of $1,000. You have performed more than the S&P 500 in a month. You have performed more than most people's money in the bank. Now, that grows you because when you have such results, of course, you have times that you lose. But because you are risking 1 to 2% on your account, when you lose $10 on your 1K, you are not perplexed to be like, oh, let me go and get it back at Ori, right? So these are the things that beginners fail to understand and why most of them will not continue here in the next 3, 4, 5 years, right? So on the topic of over leveraging, use a safe leverage ratio, usually ratio 1 to 10 or 20 or even 50. I still use leverage of 1 to 100 because I remember to risk 1% on my account. But anything that is ratio 1 to 500, ratio 1 to 1,000, you are doing too much, basically. And always remember to only risk 1 to 2% of your account per trade. It is very important. It will keep you here longer than most. All right. Moving on to the next one. Ignoring risk management. This is a big one. Ignoring risk management. So many beginners focus only on making profit, forgetting that protecting capital is more important. And here's the solution to that. I don't think I need to overflog that because I've always mentioned that when it comes to Forex trading, in fact, what is most likely to happen to you is to lose money. There are high chances of you losing money, especially as a beginner, than you making money, right? So therefore, protecting your capital is everything to you. It's everything to you. And the solution to this is always set a stop loss before entering a trade. You already took what stop loss and take profits are. Before you enter a position, like myself, I know how much I am risking. And how much I'm risking is within the area of 1 to 2% of my total account, right? So once I know that, oh, this $1,000, I'm risking 10 in this trade. Is this position able to give me 10? If 10 is too tight and it might just hit my stop loss and still go my way because I'm not letting the trade breathe, okay, what about 2%? oh, 2%, this is where it's going to, I think the stop loss is comfortable here. I can afford to risk $20 on this trade to find out if I'm going to be right or wrong before I enter a trade. And secondly, follow a risk to reward ratio 1 to 2 or better to stay profitable over time. And this is why this is important. Sometimes as well, I've been tempted to want ratio 1 to 5, ratio 1 to 7, ratio 1 to 10. It sounds good and it sounds nice. It sounds like a good bragging right to your friends that, oh, now I trade Forex and I reach $10 and I make 100. It's fine. But the problem is you would not always have such leverage. In fact, as a beginner, you might not have had the time to study how far each currency PM moves per session. Some pairs only give you like 50 pips or 25 pips or 30 pips or 100 pips, depending on the time of the session that you are trading. But if you had not taken the time to study and understand, and you are in a position you are waiting for 1 to 10, it might never happen and you get frustrated. But you risk $10 to make 1 to 3 ratio, or to make 20 1 to 2 ratio, and you are able to do it over and over. You are good to go, right? So risk management also, apart from protecting your account from by using stop losses, also has to do with using the best risk to reward ratio, so that you are also making money while you are growing, not waiting to make $1,000 off a simple trade. Not one trade as a beginner with a small account is not enough to retire you or take care of your parents. So just take it gradually as you grow. All right, so let's move on to the next one. The next one is revenge trading. This one is a direct response that most traders take whenever they lose a trade. So let's go through what we have in our notes. So after losing a trade, many traders try to win back their losses by rushing into another trade without proper analysis. This leads to more losses and emotional distress. Trust me, I've been through this one. The market takes you out, hits your stop loss, you just get back in, you revenge trade. Oh, I'm going to get my money back. I'm trying to make it back. I'm trying to make it back. I'm trying to make it back. That's how you blow account. Why? Why are you in a hurry? That play is done. You set your stop loss. You expected that the market will go this way. It went the wrong way. Hit your stop loss. Let it go. Take some step back and reanalyze before you enter another position. All right? So the solution to this is to accept that losses are part of trading. Take a break after a loss and analyze what went wrong before taking another trade. In fact, most of the time, I like to close all my trading positions, see a movie or hit the gym or call a friend, just to do something that distracts me. Sometimes when I have like losses for like 2 days or 1 week, the following week I might not even come trading at all, just to cool off and reset my mind and come back and tell myself, oh, we are not trying to build Rome in one day, right? And that leads us to the next one, which is trading too frequently. Over trading. There is such thing as over trading, and beginners often believe that they must be in the market at all times. Over trading increases risk and leads to bad decision. Over trading is a thing. It happens to most of us. We got to learn about having, oh, once I'm done in this, I'm done for the day, whether profit or is loss. Because the thing is, you have to focus on quality trades and not quantity. Then secondly, trade only when high probability setups appear. And from the strategy that I use to trade, these high probability setups usually happen around support or resistance area. That is when there are bounces in the market or breakout and retest, just like we discussed, I think, in week 2 or 3. All right. So this is important for you to know as a beginner. Also, not understanding market conditions. New traders often try to trade in all market conditions without knowing if the market is trending or ranging. Remember what a ranging market is. That one that doesn't have a new high or significant low. It's just going between a particular price on the upside and on the downside of the market. The best trading conditions is when market is trending, is going in a direction, making higher high or higher low, or lower low, lower high for downtrend or uptrend. that is when to find the best setups, right? So identify trending versus ranging market before placing a trade. Adjust your strategy based on market condition. So like last week, let me quickly show you something. Last week Monday was so amazing. This is daily candle. So this happened in 1, 2, 3. These big three candles happened in 3 days, and market was just all bullish. If I go down to lower time frame, you see how it gave us structure, and market doesn't always move like that, right? And what happened to that market condition was the awareness of the fundamental that came out on dollar and Donald Trump's tariff in the United States of America, right? So that created a lot of volatility in the market, providing opportunity for good traders to come and pick their 100, 200, 1,000, 2,000, 10,000, 100,000, depending on their account size, right? So identifying market conditions is very important. Moving forward, letting emotion control trading. Fear and greed can cause bad decisions like exiting a trade too early or holding on to losing trades. You see, this exiting a trade too early comes in two dimensions. So let's say you enter into a trade, you want a ratio 1 to 2. Closing before you get the 1 to 2 because you saw some money and you want to take it out might be a bad decision. Or doing too much, letting greed get into your mind, and after 1 to 2 you want to leave it and let it ride without the proper skill to use, can also be a bad decision. So stick to your plan and focus on where you are going to. Or holding on to a losing trade as well. Traders will let trade go against them. Number one, they won't set stop losses, and now trade is against them after the 1% down. The account is down 2%, 5%, 20%, 30%, and they won't close it, saying, oh, the market is going to come back to where they entered from or back into profit, which is too much well wishing. Sometimes it can happen, but 1 in 10 times it hardly happens like that. All right. So the solution to this is to trade logically, not emotionally. Logically, in the sense that when I see this, I do this. When this happens, I do that. And also use a trading journal to track emotions and improve decision making. You want to remember how you felt when you were in a particular trade. Oh, when I won this trade, I was so excited I entered another one and I lost. That happens to me most times. So most times when I have a good winning trade, I try to just let the market be and not take any other setups. So these are some of the things to use in not letting emotion control your trading. Number 8, failing to backtest a strategy. So jumping into a live trading without testing a strategy leads to unnecessary losses. Unnecessary losses, bro. Backtesting is, you can backtest in many ways, right? If we have trading view pro, we can replay this market to go back in time, and so that we see how the market behaved in the past and try to be like, oh, if the market did this, what would I have done in this area, right? So let's say, for example, I'm backtesting this now. I see a high here. This high is not up to this high. This high is not up to this high. And there is low. Does it look like it's going down from here? Maybe this trend has changed. Let me see. I play again. And then, okay, wicked out. If I'd enter here, I put my stop loss here, will have taken me out. All right. Okay, I can pause from here. If I put my stop loss here, it will have stopped me, but now it's trending down. What can I do? I can play that again and see and be like, okay, it's making lower low again. I'm looking if I will get a retracement, then I'm going to sell, depending on my strategy. That is for the advanced class anyways. But I want you to understand that we can also just open a demo account. A demo account will help us know, oh, forward testing. So I'm trading on a fake money, on real market condition. This is what I would do if I saw this. This is support, this is resistance. I sell from support, I buy from support, I sell from resistance. This is what I would have done. This is where I would have put my stop loss. I record it down. Over time, over a week, 2 weeks, I've seen some things that I would not do when I'm on live account, and some things that I want to practice. So that is important. But many traders don't do this. They just jump into the live market just like that, which is a terrible thing to do. All right. Moving on. Key takeaway. Always trade with a plan and risk management rules. It is very important. If you are going to be a successful trader, it is non-negotiable. Avoid revenge trading and over trading. Emotions have no place in trading. Follow your strategy. And this strategy, personally, you are going to develop it over time. When we are done with the whole week 6, I'm going to share my own personal strategy with you, and probably we'll even be on a live market together. You see how I take losses or how I take profit, right? Market condition change. So adapt, approach accordingly. So for example, currently the market is moving mad because of what Trump is doing with the United States economy right now. For somebody that trades stocks, for example, S&P 500, which is an index fund for 500 companies in the United States, had been bullish forever, but recently, because of current market condition, it started crashing. A good trader knows when to, although these have been bullish, but right now there are no opportunities. I'm calm about it. Those are some of the things a good trader does. So in conclusion, every successful trader has made mistakes, but what sets them apart is their ability to learn and improve. By avoiding these beginners' mistakes, you build better habits and become a more disciplined trader. That will be all for now. I hope to see you in the next one.